The skyline in Istanbul, packed with skyscrapers and shopping malls, is concrete proof of Turkey's dynamism. But the future of this emerging market bellwether might not be so impressive. Amid difficult domestic and international conditions, the roar of Turkey's economy has become more of a whimper.
While the country's entry into the world economy took place over more than 30 years, growth picked up after the AK Party's 2002 arrival in power. It hit maximum velocity in the early years of this decade, reaching 9%, second only to China.
With the single-party government, privatization efforts speed up in Turkey. This helped these companies to be emerged and became global and international companies. So global and international companies attracted foreign direct investment to Turkey. So this helped Turkish economy to be very good during the past decade.
The government stresses that its public accounts are in sound shape and that growth is far higher than in neighbours such as the Eurozone.
The main economic accomplishment, I would say, has been the correction of the fiscal dynamics. By that I mean a public debt GDP ratio that hovered around 90% roughly 13 years ago, which is now around 35% and still coming down. And the budget deficit, which hovered around 17–18% of GDP, we saw those numbers in the past, is now around 1.3–1.2% of GDP. And these are some of the lowest numbers on earth at this moment. And this happening in Turkey is a dream come true.
But today, Turkey, like other emerging markets, faces slower growth than in recent years and more of a struggle to attract the foreign funds on which the economy has become dependent. One big test will be the impact of US interest rate rises likely later this year. The lira has already slid to all-time lows against the dollar.
One of the biggest structural problems in Turkish economy is the low saving rate. It's about 13–14% of GDP right now. But our investment ratio, this is already very low, runs in the 20%. And we want to actually raise it even higher because 20 is not that high to begin with. So the two combined basically makes up a very large current account deficit. And current account deficit means you have to finance it with other people's money. And so basically the story goes that you have a big financing requirement, you have a large debt every year to roll over. It's not the end of the world because there's still a lot of liquidity out there, but it's a constant source of vulnerability.
Unless enough money comes into the country, the lira could fall further, making it harder for Turkey's corporates to service their $180 billion in foreign currency debts.
But a more fundamental issue is what kind of growth Turkey will have. At the moment, the economy is bumping along below 3%. Exports and consumer confidence are down. A technocratic wing of the ruling AK Party says the country needs tax and labour market reform if Turkey is to avoid the middle-income trap.
President Recep Tayyip Erdogan's advisers have suggested an alternative: lower interest rates and a more competitive exchange rate to boost construction and manufacturing companies, even at the cost of pushing up inflation and increasing the burden of dollar debt. The growing consensus is that Turkey's economic model is running out of steam. The country's future depends on which alternative it opts for. Daniel Dombey, Financial Times, Istanbul.